Ladies and gentlemen, dear colleagues and friends, I bid you a very warm welcome here today at the Bundesbank Policy Symposium entitled Frontiers in Central Banking, Past, Present and Future. Conferences like this one feed off the knowledge and experience of their participants. And that's why I'm proud that so many high-ranking academics and policymakers have accepted our invitation to be here today. Let me therefore extend my cordial thanks to all the panelists and moderators who are involved in this event today. And I'm particularly indebted to Ottmar Issing, who will make some concluding remarks at the end of today's proceedings, and I know this is usually a daunting task. But as Karl Popper once pointed out, no matter how knowledgeable we are, to find out whether our ideas are sound, we need other people to try them out on. And that's the reason for today's symposium. And that's why I would like to thank the organizers, and especially Emanuel Münch and his team, who arranged the program. Ladies and gentlemen, I'm quite sure I'm telling you nothing new when I say that modern central banking is a consequence of crisis. The Federal Reserve is a prominent example. It was established in 1913 as an answer to financial panics. When in the 19th century, bank deposits began to emerge alongside banknotes, financial soundness became an issue for central banks. Banks operating in a fractional reserve system are susceptible to bank runs. And that's why the function of the central bank as a lender of last resort gained importance, a development which was described in particularly lucid terms by the British journalist, businessman, and essayist Walter Bagehot in his book Lombard Street. Financial panics and bank runs were a recurring feature at the time, particularly during the second half of the 19th century and the early years of the 20th century. Not only, by the way, in the United Kingdom, but of course also in the United States and other countries. The sole original purpose of the Fed then was to preserve financial stability. According to Robert Latham Owen, one of the authors of the Federal Reserve Act, the Fed was established to provide a means by which periodic panics, which shake the American Republic and do it enormous injury, shall be stopped. Today, however, we know that placing the primary focus on financial stability turned out to be problematic. When speculative lending ballooned in the late 1920s, the Fed, in pursuit of its mandate, tightened monetary conditions in a situation when inflation rates were already slightly negative. While the Fed could not stop asset prices from soaring, its interest rate moves contributed to an economic downturn. And this disconnect threw into sharp relief the mispricing in the asset market. The crash of October 29 was then followed by waves of bank failures. Having seen the impact of the Great Depression, central banks increasingly shifted their focus towards macroeconomic objectives, price stability, and in the case of the Fed, employment. Financial stability, by contrast, dropped off monetary policymakers' radar. The Deutsche Bundesbank is another example of the role which crisis played in the definition of a central bank's mandate. When the bank was established, exactly 60 years ago, there was a broad understanding that its primary objective should be to maintain the stability of the currency. After the German population had suffered the loss of their savings twice in the first half of the 20th century, in the early 20s due to hyperinflation, and after the Second World War due to the suppressed inflation caused by the wartime economy and the ensuing currency reform, they held price stability in very high store. And so it was widely appreciated by society that the Bundesbank interpreted its mandate as meaning that it should maintain price stability. The oil crisis of the 70s and 80s were further events that shaped central banking. It was during this time that the merits of politically independent central banks like the Bundesbank and the Swiss National Bank came into sharp focus. They were able to disconnect their economies from the worldwide inflation train by pursuing policies which were aimed squarely at preserving price stability. As a consequence, their institutional design formed the basis for the global consensus about monetary policy, a consensus which is still in place today. First, central banks should primarily aim to maintain price stability, that is to say, consumer price stability. Second, central banks should be independent of their governments. Third, the credibility of central banks' commitment to low but slightly positive inflation by anchoring inflation expectations is key to their ability to deliver on the price stability objective. This consensus shaped the statutes of many central banks, not least that of the European Central Bank, which was agreed upon in 1991. But this view was fundamentally challenged when the crisis struck. Central banks around the world intervened on a massive scale. Interest rates were slashed to all-time lows, and unprecedented non-standard measures were rolled out. This was in keeping with the then reigning consensus that monetary policy cannot be used effectively to deflate a bubble, but it can clean up afterwards if a bubble bursts. A consensus which was called into question after the crisis. In the euro area, where the financial and economic crisis evolved into a sovereign debt crisis in 2010, monetary policy makers repeatedly came under pressure to prevent the crisis from escalating. And sometimes they went to the very limits of their mandate. Central banks all over the world reacted in a classic Badger fashion when the financial crisis erupted. As soon as mistrust between private money market players began to take hold, and the spread between the risk premiums for secured and unsecured money market transactions skyrocketed, the volume of money market transactions fell and the number of participants in monetary policy operations soared. The Governing Council of the ECB reacted swiftly and decisively by switching its refinancing operations to tenders with full allotment. As long as banks were able to pledge adequate collateral, they received unlimited amounts of liquidity from the Eurosystem. In practice, this allowed them to bypass the strained interbank market. The Governing Council also offered additional longer-term refinancing operations, including the 3-year refinancing operation at the end of 2011 and the beginning of 2012 in particular. This way, the Eurosystem took over much of the role of the money market's role as an intermediary. In doing so, it made sure that monetary policy impulses would still find their way into the real economy. And by lending freely, it helped dispel doubts, concerns about banks' liquidity, and thus also prevent a run. By providing oxygen to the economy, central banks are able to offer vital support. But in the long term, an oxygen supply is no substitute for a healthy heart. Quite the opposite is true in fact. If a tank of oxygen takes the place of exercise and a healthy diet, it might prolong the condition if it's administered for too long. Hence, if the abundant injections of central bank money are used not only to bridge temporary liquidity shortfalls, but in extremis to keep insolvent banks on a long-term life support, matters could get tricky. The more the central bank safeguards banks against risk and promises them central bank funding, even in dubious situations, the more they will have an incentive to take on excessive risks, of course, and that's what Raghu Rajan and Jean Tirole, amongst others, have convincingly argued, and they argue that the implicit promise of a central bank to step in by lowering interest rates and injecting liquidity when banks default whets banks' appetite for risk. And this also shows that selecting an appropriate strategy for liquidity provision is something of a balancing act. Being too restrictive in granting liquidity can cause a spark to turn into a fire. Granting liquidity too liberally, on the other hand, and propping up institutions without sustainable business models may also mean that the water used to extinguish the fire ends up causing more damage than the fire itself. And this, of course, is all the more relevant as it's hard to determine ex ante whether an institution is illiquid or insolvent. By the same token, another unconventional policy comes with risks attached as well. And I'm talking about the large-scale purchases of sovereign debt, which have been deployed by many central banks in response to the crisis. By buying up large quantities of sovereign bonds, central banks are able to push down long-term interest rates. And this, of course, provides additional monetary policy stimulus, but at the cost of potentially becoming a sovereign's largest creditor. In a currency union like the European one, with a single monetary policy, but national economic and fiscal policies, sovereign bond purchases blur those all-important boundaries between monetary and fiscal policy. At the end of the day, this can lead to political pressure being exerted on the euro system to maintain the very accommodative monetary policy stance for longer than appropriate from a price stability standpoint. After all, in the context of these asset purchases, changes in monetary policy impact much more directly on governments' funding costs than interest rates moves. And they are naturally also more problematic in view of the disciplining effects of the capital markets on government finances. And this is a risk for the euro area in particular, a risk as risk differentiation between the different countries is significantly reduced. Still, the risk-reward profile of sovereign bond purchases certainly differs depending on the institutional setup of the policy area in question. A central bank buying up federal bonds to drive down the long-term risk-free interest rate with a view to speeding up inflation is a different kettle of fish from one acting as a lender of last resort to governments. And this brings me to the issue debated in today's second panel. Who is willing to act, passing on the hot potato of policy intervention? Economists like Paul de Grauwe argue that monetary policymakers should channel their inner badger, so to speak, when it comes to sovereign debt. In his view, a sovereign that is actually solvent but suddenly falls prey to the skeptical gaze of the market can be driven into insolvency by the rising interest rate burden. Downgraded market perceptions can amount to a self-fulfilling prophecy, a phenomenon which economists refer to as markets with multiple equilibria. In such cases, a central bank should come to a country's aid, according to Paul de Grauwe, just as acting as the lender of last resort to banks serves to safeguard financial stability, so too could central bank intervention in the government bond market fulfill the same purpose. But for me, this stretches the analogy too far. Lending to governments is different in that it's not collateralized. Walter Bagehot advises central banks to lend to banks only against adequate collateral, such that moral hazard is minimized. Buying up sovereign bonds amounts to lending to governments without mitigating the risk of moral hazard that comes with it. The second difficulty stems from the fact that it's exceedingly difficult to determine the fundamentally justified price for sovereign debt. In other words, it's all but impossible to judge whether the market reaction is justified or overblown. In determining the price by themselves, central banks are setting themselves up for pressure from governments who tend to think anyway that they deserve better rates. It follows from the notion of central banks acting as a lender of last resort to governments is less in keeping with the Bagehot tradition than is sometimes assumed. And it runs into arguably far greater problems with moral hazard, especially in a monetary union with fiscally sovereign member states, as I mentioned before. Incentives to reform public finances and the real economy are stunted, and if action is taken at the national level but accountability is located at the European level, chances are that the euro area growth will atrophy rather than accelerate. Who then should take on the hot potato of policy intervention to avoid the pitfalls of last resort lending when a country runs into financing troubles? It might help to look at what can be done to mitigate the ill effects of central bank lending to banks. The answer here is an effective bank recovery and resolution regime. If banks turn out to be not temporarily illiquid but truly insolvent, they will need to be restructured or resolved. As the late Alan Meltzer once quipped, capitalism without failure is like religion without sin. It just doesn't work. And this holds for banks and for companies in general. In the euro area, progress has been made in terms of requiring banks to hold higher capital buffers, as well as establishing the single resolution mechanism. But similar progress is lacking when it comes to the possibility of restructuring sovereign debt. The ESM, though, could function as a vehicle for such a regime, but crucial elements are still missing. One such element is changing the contractual terms of government bonds in the euro area by introducing an automatic maturity extension for all bonds, which would be activated the moment the government applies for an SME ESM program. Ongoing deficits would therefore be financed, but original creditors would not be paid off for maturing bonds. Not only would this continue to provide incentives for private creditors to lend cautiously, it would also significantly reduce the need for financial aid under an ESM program. Furthermore, it would vastly broaden the scope of the rescue mechanism. Had it been possible to automatically extend the maturity of bonds back in 2011, Portugal would only have needed around 43 billion euro to cover its entire budget deficit until 2014, rather than the 76 billion in total that it received in financial assistance loans. This solution would allow the ESM to work as a restructuring regime. Automatic maturity extension buys time to figure out whether a country is merely facing a liquidity shortfall or is in fact insolvent. Bonds bought by private creditors can still be restructured at a later date, while official support can be used to smooth the economic adjustment process. Of course, the financial system in this case must also be able to withstand a debt restructuring. Otherwise, precious little would have been gained. Because privileged regulatory treatment allows banks to buy almost unlimited amounts of government bonds, which they are not required to back with capital, a haircut is particularly risky for banks when it comes to sovereign debt. And that has to change. Not until banks have begun to hold sufficient capital against government bonds and the size of individual exposures has been limited, will banks be able to effectively cope with the process of restructuring sovereign debt. And only then is there likely to be any concrete political will to take such action. Government bonds are far from being risk-free, as we learned the hard way during the crisis, and banking regulation should acknowledge this fact once and for all. Capping the size of individual sovereign exposures in bank balance sheets would provide much of the diversification benefits that are envisaged by the European Safe Bond proposal the European Commission has recently taken up. And that proposal conceives a diversified security where member state sovereign debt is pooled and then divided into a safe tranche and a union tranche, thereby providing for a risk-free asset. But a European safe bond created by an official European entity could be perceived as a stepping stone towards full-blown Eurobonds that means mutual liability. To avoid that perception, European safe bonds would have to be constructed by market participants. And it would be easier still to split new sovereign bonds into senior and junior bonds at the time of issuance and at the national level, sensibly adding a maturity extension feature for the junior bond. Combined with effective regulation of sovereign bonds, this solution would offer the same advantages of diversification and safe asset generation while being arguably much more feasible politically. These are steps that would allow the potato to be taken when it's hot. But of course, it would be better still not let matters come to the boil in the first place. And this means strengthening sustainable growth. I'm convinced that we all share the view that it's not central banks which can put the economy on a higher growth path. It's up to governments to unlock the potential of economic growth, and what's needed are reforms fostering competition and innovation to make investment more profitable. With regard to Europe, the completion of the common service market and the creation of a single digital market are promising initiatives. Studies, for instance, suggest that this could yield double the growth effects unleashed by the creation of the common market for goods. By the same token, unleashing the forces of the market would not only solve growth, More geographically diversified investment would strengthen risk sharing as well, as profits and losses are shared more across borders. The euro area has some catching up to do when it comes to private risk sharing, and this is why we need to press ahead with the Capital Markets Union. Lowering the barriers that prevent enterprises from exiting the market would likewise foster growth. It would facilitate what Josef Schumpeter called creative destruction, and OECD research suggests that policy-induced exit barriers matter for productivity growth because fewer exits lead to less scope for productivity spillovers and to the misallocation of labor and capital and skills. It concludes, for instance, that insolvency regimes should be streamlined, and this would also be important when it comes to financial market integration, i.e. the Capital Markets Union and private risk sharing. And investing more in skills and education promises to deliver rich rewards too. This would not only boost labor productivity, but also make workers less at risk of losing their jobs. And this, in turn, would be the most effective antidote to the widespread sense of being fundamentally threatened by globalization and technological progress. Fortunately, many of the measures that foster growth make also the economies more resilient. And more resilience is needed because long recessions can reduce potential growth. But more can be done to bolster resilience, for instance, by shoring up the shock-absorbing capacity of public finances. And with regard to the euro area, this implies stronger fiscal discipline and compliance with the fiscal rules of the Stability and Growth Pact. Ladies and gentlemen, dear guests, getting the issue of policy intervention right still seems to be a formidable task. But while no effort should be spared in addressing this topic, central banks need to be aware that more often than not, change is not the result of crisis, but of technology. Every technology comes with technical risks, and the recent WannaCry cyber attacks are a case in point. But the main challenge for central banks will probably lie with the tectonic shifts triggered by digitalization. Digitalization will spawn new forms of financial intermediation. While this might be a boon to the economy, central banks will be faced with questions regarding the transmission of their monetary policy. Some even suggest that privately issued digital currencies might do away with our currencies altogether. However, closer economic analysis indicates that this scenario is likely to be overblown. As a medium of exchange and unit of account, money is subject to substantial network externalities that alternative currencies seem unlikely to overcome. I'm also pretty confident that central banks are better able to deliver price stability than a rigid monetary rule or an algorithm. But even if private digital currencies do remain a fringe phenomenon, central banks are urged by some to consider embracing the new era by issuing their own digital currencies. This would mean that non-financial corporations and even households would have access to the central bank balance sheet in the form of digital balances, which, unlike cash, have no noteworthy storage costs. What might appear intriguing from a technological point of view raises very fundamental questions about the nature of the financial system and our economy at large. Allowing the public to hold digital claims on the central bank might make their liquid assets safer, because a central bank cannot become insolvent. And this is a future which will become especially relevant, of course, in times of crisis, when there will be a strong incentive for money holders to switch bank deposits into the official digital currency at the push of a button. But what might be a boon for savers in search of safety might be a bane for banks, as this makes a bank run potentially even easier. But in taking deposits away from banks, it also removes their ability to engage in maturity and liquidity transformation and make loans. A new technology, therefore, reopens a very old debate in economics. Does maturity transformation enhance welfare, or should banks be prevented from creating liquidity? My personal take on this is that central banks should strive to make existing payment systems more efficient and still faster than they already are. Instant payment is the buzzword here. And I'm pretty confident that this will reduce most citizens' interest in a digital currency. Ladies and gentlemen, at this point, I would like to conclude. Modern central banking itself is the consequence of economic crisis. But it's certainly not the answer to end all questions. And for the host of an economic conference like this is not necessarily a bad thing, but I would say rather a good thing. So on that note, I'm looking forward to the answers our esteemed participants are coming up with. And I have the pleasure to announce the first panel on the benefits and boundaries of unconventional monetary policy. And we have three very eminent panelists. We have Masaki Shirakawa, we have Jean-Claude Trichet, and Axel Weber, and I would ask you to take the floor. And we have Volker Wieland as moderator. I have spotted him somewhere. So you're all invited to come now. I'm finished. Thank you very much for your attention.